Get ready for the action because SM Plus Data Centers, alongside Korea Investment Real Asset Management and LG Sinar Maz, has officially reached a massive topping-out milestone for their SMX-01 data center in Jakarta. This groundbreaking facility is shaping up to be an AI-ready, carrier-neutral powerhouse, designed to handle massive cloud, enterprise, and artificial intelligence workloads, and it's set to officially launch its services in the fourth quarter of 2026. We dive into how this project is transforming Jakarta's digital infrastructure landscape and what it means for the region's technological future.
Tired of dropping your phone or struggling to hold it with one hand? The PopSocket's Pop Grip gives you a secure grip, works as a phone stand, and even lets you swap the top for a fresh new look. Simple, useful, and perfect for everyday phone use. Click the link in the comments to grab yours on Amazon.
The energy landscape in Texas is undergoing a seismic shift as gas power leaps over wind for the first time in a decade in the grid connection queue. Driven by the explosion of data centers flooding the state, the volume of gas generation in the interconnection queue has now surpassed wind power for the first time since 2016, signaling a major pivot in how Texas plans to power its massive digital growth. We explore the economic headwinds facing wind and the massive demand driving this gas comeback. The AI boom is not just changing data center real estate, it is fundamentally reshaping American manufacturing and supply chains. Chip-making giant Nvidia is partnering with Corning to develop 3 new manufacturing facilities in North Carolina and Texas, framing this deal as a massive opportunity to reinvigorate American industry. We look at how this infrastructure surge is fueling everything from switchgear manufacturing to the development of logistics hubs, supporting these critical tech supply chains. But the power race continues as Chevron seeks a massive state tax break in Texas to build a gas power plant specifically to fuel a data center destined for a Microsoft tenant. This move highlights the intense battle between big tech and rising electricity costs, and the complex policy decisions surrounding data center incentives. Stay with us as we break down the financial stakes and the future of energy infrastructure. SM Plus Data Centers has achieved a significant milestone with the topping out of its SMX-01 data center facility in Jakarta. The project, a collaboration involving SM Plus Data Centers, Korea Investment Real Asset Management, and LG Sinar Maz, marks a critical step toward the facility's planned service launch in the fourth quarter of 2026. Strategically situated in Jakarta's central business district, the new data center is being developed with a focus on being AI-ready and carrier-neutral. This infrastructure is specifically designed to support demanding workloads across cloud computing, enterprise applications, and artificial intelligence. The completion of this phase is part of a larger strategic initiative aimed at expanding the region's digital infrastructure capabilities. Noi Dung Kai Tight. Gas power has overtaken wind in the Texas grid's interconnection queue for the first time in a decade, signaling a significant shift in the state's energy landscape driven by the surge in data center development. For the last 6 months, the volume of gas generation projects in the queue has surpassed wind. Reflecting policy and economic pressures on the wind industry, and the growing demand from data centers seeking 24/7 power for artificial intelligence operations. /N University of Texas professor of energy regulation David Spence noted that the data center explosion and their need for continuous power have significantly boosted gas developers. /N, the Electric Reliability Council of Texas, or ERCOT, uses the interconnection queue to manage new power generation. While only 22% of projects in the queue are ultimately built, the queue provides critical future insight. Data shows that solar and battery projects dominate the queue, accounting for 75% of the 458,000 megawatts listed, with gas and wind making up the remainder. /N, however, the gas project volume has experienced explosive growth, jumping over 400% from 12,500 megawatts in March 2023 to nearly 64,000 megawatts as of last month. This increase is supported by the Texas Energy Fund, which offers low-interest loans for dispatchable power like gas plants, with approximately 9,000 megawatts in the queue receiving these loans. And the primary catalyst for this gas ramp-up is the massive power demand associated with prospective data centers, which ERCOT estimates at around 360,000 megawatts. ERCOT CEO Pablo Vega stated that if such demand is met, we're going to clearly need a lot more of gas generation in order to have a balanced and reliable grid. And Vegas argues that the market design, established 25 years ago, has failed to value the reliability characteristics of dispatchable energy sources like natural gas, prioritizing cheap, intermittent renewables instead. He contends that thermal generators offer reliability that batteries and solar alone cannot provide in the long term. And despite the demand, the gas supply chain faces bottlenecks, with turbine orders potentially taking until 2031 to arrive, although developers are finding innovative solutions, such as repurposing existing turbines. Furthermore, the perceived economic value of securing data center power is immense, driving developers toward unconventional solutions. And meanwhile, wind power is facing significant headwinds. Since its peak in 2018, wind has fallen behind all other major generation sources. Key challenges include the saturation of prime development locations in West Texas and the coastal region, leading to transmission congestion and power curtailment. Additionally, the rapid cost decline of solar energy makes solar plus battery storage an increasingly attractive business model. And policy uncertainty, including federal hurdles like the FAA's 200-foot rule for onshore turbines, has also spooked investors, complicating financing for wind projects. Noi Dung Kai Tight. The artificial intelligence boom is fundamentally reshaping commercial real estate, with data centers emerging as a primary growth engine, driving significant ripple effects across the U.S. manufacturing and logistics sectors. This infrastructure explosion is catalyzing a new wave of industrial development and supply chain investment. And key partnerships are solidifying this trend. Chip-making giant Nvidia has announced a collaboration with Corning, an optical connectivity equipment manufacturer, to develop 3 new manufacturing facilities in North Carolina and Texas. Both companies view this as an opportunity to leverage AI to reinvigorate American manufacturing and supply chains, signaling that the AI infrastructure boom is a tangible manufacturing story. And this focus on the data center supply chain is evident across the industrial landscape. Siemens opened a $190 million manufacturing hub in Fort Worth for data center electrical gear, while Eaton began work on a $30 million switchgear facility in Nebraska. Cooling system manufacturers nVent and ON have also expanded operations in Minnesota and Tennessee. And furthermore, major semiconductor fabrication projects, such as those by Intel and TSMC, are consuming massive capital, with costs nearing $100 billion, to build the chip fabs necessary for GPUs and processors powering data centers. Elon Musk is also exploring a major semiconductor facility near College Station, Texas, underscoring the scale of investment. And data validates this industrial shift. CBRE Global Head of Industrial Research, James Breeze, noted that manufacturing leasing activity surged 28% in the first 3 months of the year. Crucially, 27% of manufacturing tenants signing deals were from the data center and tech supply chain industries. And Breeze emphasized that this demand is tied less to initial construction and more to the ongoing upkeep and replacement cycles for in-data center equipment, suggesting more stabilized, long-term demand. This trend is fueling a build-out of logistics infrastructure tailored for data center needs, with firms like the Blev Group focusing on last-mile warehouses, and Prolog is reporting a significant increase in data center supplier leases. The lines between manufacturing and logistics are blurring, with warehousing and manufacturing increasingly co-locating on the same sites, particularly through prefabrication hubs. Construction firms like DPR are shifting from traditional project delivery to product delivery by establishing regional prefab sites to assemble components like electrical skids and cooling systems off-site. This hub-and-spoke model is overcoming traditional logistical constraints, allowing components to be shipped efficiently to data center campuses, even over long distances. \N geographically, the impact is expanding beyond traditional hubs. While Silicon Valley remains important, Avison Young's data highlights Columbus, Ohio, as a rapidly emerging industrial market, fueled by data center growth and major chip fabrication projects. This demonstrates that the data center ecosystem is spurring manufacturing and logistics demand in previously secondary markets, reshaping the national industrial map. Chevron is aggressively pursuing a multi-hundred-million-dollar state tax break in Texas to construct a large power plant intended exclusively to supply electricity for a data center, potentially for a future tenant like Microsoft. Chevron's subsidiary Energy Forge One has submitted an application to the State Comptroller's Board seeking a tax abatement under Texas Jobs, Energy, Technology, and Innovation (JETI) Act. The application has garnered support, with the Comptroller's Office recommending approval, marking the first such approval for a power plant dedicated solely to data center use. This initiative comes amid growing public scrutiny and legislative concern over the massive incentives provided to data center developers, which some states, including Texas, are projecting could cost billions annually. The potential tax abatement for the Chevron project could yield over $227 million in savings for the company over 10 years. The project is slated to utilize a behind-the-meter gas plant, designed to provide direct electricity consumption to the data center rather than connecting to the main grid, a growing trend for developers facing grid connection delays. While Chevron is seeking incentives, the situation is complicated by ongoing negotiations with Microsoft. Chevron has an exclusivity agreement with Microsoft and Engine One, and Microsoft has pledged to pay a full and fair share of local property taxes in communities where it builds data centers. However, corporate representatives confirm there is no definitive agreement finalized regarding this specific power plant. Chevron spokesperson Paula Beasley clarified that the proposed tax incentives apply only to the power generation facility and do not extend to any future data center facilities. Furthermore, the JETI program explicitly excludes data centers from eligibility. The project has received local approval, with the PECO's Barstow-Toyah School Board endorsing the application. Despite the state covering the tax abatement, the project is projected to create over 25 permanent jobs. Environmental concerns have also been raised, as an analysis indicated the Energy Forge plant could emit more CO2 equivalent annually than the country of Jamaica in 2024. Experts caution that the JETI program, while an improvement over previous versions, still has relatively low guardrails. Government professor Nathan Jensen noted that the incentives could be routine, pointing to past instances where similar programs provided substantial tax breaks with limited oversight. The broader context shows a battle between infrastructure development and fiscal responsibility. Bipartisan politicians in Texas are concerned about the escalating costs of data center tax breaks, with one lieutenant governor ordering a study into potential sales, tax exemptions projected to reach $3 billion by 2029. Meanwhile, advocates suggest restructuring tax code to mandate grid connection for data centers, making behind-the-meter solutions less favorable, and pushing for permitting reform to accelerate clean energy integration.